Welcome back, finance enthusiasts. The SIE, or Securities Industry Essential Exam, is an excellent way to begin your career in the financial investment sector. It encompasses the fundamentals of the industry and prepares you for more advanced examinations. Now, let us continue preparing you to pass the Securities Industry Essentials exam with a discussion into the different classifications of stocks, the follow-up from our previous equities video. We will continue into rights and warrants in our next video. Let us begin with an overview of classifications of stocks. The goal of this segment in the series is to enhance a person's understanding of the following equity-related concepts: features of ownership, such as order of liquidation and limited liability, voting rights, convertibility, as well as control and restrictions like SEC Rule 144. The process of issuing and trading these securities will be discussed in subsequent segments of this series. Different classifications of stocks. Specific stocks are often categorized based on size, such as large, mid, or small cap, or type of issuing company, assumed risk, expected return, or correlation to the business cycle. The following section lists some of the more common classifications. Blue chip stocks. Blue chip stocks are high-grade issues from major companies that have long and consistent records of earnings and dividend payments. The term is used to denote the common stock of large, well-established, stable, and mature companies that possess significant financial strength. Growth stocks. A growth stock is an issue of a company whose sales, earnings, and market share are expanding faster than the general economy and the industry average. Typically, this type of company is aggressive, research-minded, and retains most of its earnings to finance expansion, resulting in little or no cash dividends. Defensive stocks. Defensive stocks are associated with companies that are resistant to a recession and include sectors providing necessary services like utilities, production of consumer staples such as tobacco, pharmaceuticals, soft drinks, and candy, and essentials like food. Essentially, defensive stocks relate to companies that perform well regardless of the current economic environment. It's important to distinguish between a defensive stock and a defense stock. A defense stock is issued by a company involved in manufacturing materials that are used by the armed services to defend the country. Income stocks. Income stocks are issued by companies that pay higher than average dividends relative to their market price. This type of stock is generally attractive to investors, particularly the elderly and retired, who are interested in current income rather than capital appreciation. Utility stocks are often categorized as income stocks. Cyclical stocks. Cyclical stocks are associated with companies whose earnings fluctuate with the business cycle. When business conditions improve, the company's profitability is restored and the price of its common stock rises. However, when conditions deteriorate, business for the company sharply declines, reducing its profits and, consequently, causing the stock price to drop. Examples of cyclical companies include those in household appliances, steel, construction, and automobiles. American Depositary Receipts, or ADRs. ADRs facilitate the trading of foreign stocks in the United States. An ADR represents a claim to foreign securities while the actual underlying shares are held by U.S. banks located overseas. ADRs trade in U.S. markets, whether on an exchange or over the counter, and are priced and pay dividends in U.S. dollars instead of a foreign currency. ADR shareholders have dividend rights but do not directly receive preemptive rights. An ADR may be sponsored or unsponsored. For a sponsored ADR, the company whose stock underlies the ADR pays a depositary bank to issue ADR shares in the U.S. This sponsorship allows the company to raise capital in the U.S. and to list the ADR on either the NYSE or NASDAQ. Many of the largest ADRs are sponsored. For an unsponsored ADR, the company does not pay for the cost associated with trading in the U.S. Instead, a depositary bank issues the ADR. Unsponsored ADRs trade in the OTC market and are typically quoted on the OTC link, an electronic exchange that executes trades in securities that are not eligible for NYSE or NASDAQ listing. Preferred stock is usually issued with a par or face value of $100, which corresponds to its initial market price, and carries a specified dividend. For example, a 5% preferred stock is expected to pay an annual dividend of $5, which is 5% of the par value of $100. However, the dividend rate for preferred stock may also be stated as a dollar amount. For instance, a $3 preferred stock is expected to pay a 3% annual dividend. A preferred stock's dividend rate generally represents the maximum amount that the preferred stockholders may receive. If a company is not performing well, its board of directors may choose to pay less than the full amount or may opt to pay nothing at all. Corporations attempt to make their preferred stock marketable to specific investors by adding features to their shares. Let's examine the different types of preferred stock. Cumulative preferred stock. What happens if a corporation fails to pay the full dividend on its preferred stock? If the preferred stock is cumulative, all preferred dividends that are in arrears or owed must be paid before the common stockholders receive dividends. Most preferred stock is cumulative. Assume that Warp Inc. has issued 5% preferred cumulative stock. Over the last 3 years, the widget market has been in turmoil due to the introduction of the Gidget, a cheaper foreign-made substitute. As a result, Warp Inc. has only paid the following dividends to its preferred stockholders. In year 4, after several Gidgets spontaneously combust, the Warp market rebounds. Now, Warp Inc. has sufficient earnings to pay dividends to both its preferred and common stockholders. Before the common stockholders receive any dividend payments, the company must pay $13 to the preferred shareholders, which includes the missing amounts of $3 for year 1, $3 for year 2, $2 for year 3, and the full stated $5 for year 4. Non-cumulative preferred stock. If preferred stock is non-cumulative, any missed dividend payments do not accumulate. Instead, only the current year's dividend must be paid before common stock dividends are dispersed. Now assume that Warp Inc. has issued 5% non-cumulative stock. Again, the widget market has been turbulent for the last 3 years, and consequently, the company has paid only the following dividends. In year 4, if the Warp market rebounds, how much must Warp Inc. pay to its non-cumulative preferred shareholders if it also wants to pay a common dividend? Just $5, since the preference is limited to the current year's dividend for non-cumulative preferred stock. Remember, non-cumulative preferred stock is not entitled to any missing or unpaid dividends. Participating preferred stock. For preferred stock, the stated return is generally the maximum annual income that an investor can expect to receive. However, an investor who purchases participating preferred stock may receive a greater dividend if the company performs well and its common dividends exceed a specified amount. For example, an investor owns 5% preferred stock with a potential additional payout of 3%. This investor is entitled to the 5% dividend but could receive up to 8% if the common stock dividends reach a specified level. Callable preferred stock. A company that issues callable preferred stock has the right to repurchase the stock, that is to call it back, at a specified price at some point in the future. To encourage investors to buy the stock, the call price is typically set higher than the stock's par value. Convertible preferred stock. For investors seeking greater potential for capital appreciation than typically offered by preferred stocks, convertible preferred stock may be a suitable choice. The trade-off is a lower dividend rate compared to other types of preferred stock. Investors purchasing convertible preferred stock can, at their discretion, convert the par value of the preferred stock into a predetermined number of common shares at a specified price, the stated conversion price. A feature that may be added to convertible preferred stock is the ability for the issuer to make the stock callable. The decision to convert the stock or allow it to be called will generally depend on the relative value of the common stock received through conversion compared to the call price. The preferred stock will typically trade at a value reflecting the best choice for the investor. To avoid overwhelming you with lengthy videos, we'll keep it short and easy to digest. Join us for a follow-up video continuation where we will discuss rights and warrants derivative securities. As always, please like this video so others can see it. If you are a new viewer, we invite you to join our family with a free subscription.